Just by background, I want to start with an intro saying that not all retail is formed equal. And that's the quote I'd really like you to leave you with today, because large format retail has very different characteristics from shopping centres. And you'll see our metrics and our results are very different to what our listed retail peers are doing with fashion and department stores. So just again, quick background for those of you that are not aware of Aventus. We're a listed real estate investment trust. We listed 3 years ago with $900 million worth of assets. We've more than doubled that to $2 billion worth of assets. We've got 20 centres, 92% on the East Coast, 74% metropolitan locations. Large format retail is a considerable part of the retail industry. I'll just show you a slide here that shows how large the industry is. So it's an $80 billion a year industry. One in every $4 effectively is spent in a large format centre in Australia. So large format retail centres have very different characteristics from shopping centres. Firstly, and I'll flick over to some, just to actually show you some images of our real estate. They're simple on-grade real estate with large land holdings. So we've got more than 1.2 million square metres of land sitting across 20 metro locations. So you can see those locations just in New South Wales. There's about $1 billion worth of assets in New South Wales alone. As you can see, most of these are in metro locations, large land holdings. They're really convenient. They are low capital cost, and most importantly, they're affordable rents and sustainable rents. So our average rent is still about $300 a square metre. Shopping centres, $1,000 to $3,000 a square metre. Our average occupancy costs are sitting at about 10%, and again, shopping centres are significantly more than that. In our centres, there's no department stores, there's no discount department stores. There's very little fashion. In fact, we've only got 2% exposure to fashion and apparel, and those sectors have been the weakest, and they've obviously been impacted most by online and international retailers. Again, if you're looking at most of our products, they're big and bulky. It's an emotional touch and feel experience. You're probably not going to buy a bed online or a couch online. You will actually go and research online, and you'll do your transaction actually in the store. A couple of financial highlights, because again, it's been another strong, while I just flick through some of these, it's been another strong performance from AVN in the last 6 months. This shows a snapshot of what we've actually achieved since listing in the last 3 years. And again, for your clients, we are, I believe we're actually offering your clients the highest return of all of the 40 REITs on the market. So if you invest $1 today, you're almost getting 8% distribution yield, about 40% tax deferred, and quarterly distributions as opposed to 6 monthly distributions. And as you can see on the far right-hand side, that top distributions, we've grown income since listing 3 years ago by 12%. Our like-for-like property income growth, which is the best way of measuring how a real estate investment trust is performing, has been consistently over 3%. The average in the sector is about 2%, and we've just produced a result of 3.3%. So that allows for all incentives, allows for the expenses, and basically says our rents are heading in the right direction. Just to share some other highlights, our occupancy consistently has been high. We're at 98.5%. Low cost of debt of about 3.5%, and we've driven valuation growth fully from income growth as opposed to cap rate compression. 16 of our centres out of 20 are now 100% leased, which is great, and we've had a record leasing year. We've done 81 leasing deals and 74,000 square metres, so that's about double what we generally do. They've been achieving positive spreads and low incentives, so positive spreads are well in excess of the CPI rate, and a spread is the difference between what the old tenant was paying and what a new tenant is actually paying. And the incentives are what you basically have to give over to a tenant to attract them. So our incentives are well under 5%. Both of those metrics are leading for the retail industry. Our holdover rates, which is where tenants go off a lease and basically go onto a monthly tenancy, again, shopping centre averages is sort of 5 to 10%. We're sitting at 1%. So again, these guys are locked in. We've been evolving and focusing on the everyday needs category. So our largest single category on the left-hand side is what we used to call non-household goods. So these drive weekday traffic. They generally pay higher rents, and they really boost linger time. So pets, babies. We've got health, medical, food, services, leisure and sports on the left-hand side, and they've been growing faster than basically the household category. The household category on the right-hand side is still growing, but it's really moderating with obviously the slowdown in housing sales. Yes, people are not selling their house as often as they were a couple of years ago. However, there's more renovations. So the renovation market is a $7.5 billion market in Australia, and it's sitting at a 9-month high. So we're getting some good tailwinds from that as well. So they are still sustainable, and we believe from a rent perspective, operable for a number of years. And you can see on this slide here, this is the Aventus vacancy rate in the gold. You can see the listing in FY15, and we've effectively taken vacancies from 2.9 down to about 1.5, and we've been about 400 basis points better than the industry market for the last 4 years. Why? Because we've got an expert team. So we internalised 3 months ago. We've got 70 on the team. We're all passionate. All we do is large format retail. We don't get distracted by other things. All of our competitors basically have diversified trusts. So they're experts in industrial, and they might have some residential, and they might have some large format retail. We are the largest pure play and the only expert that has a big team just focused on this area, and it's coming through in the results. You can see the affordability of the rents here as well. Top right-hand side, you can see that large format at $260 a metre is very affordable and relatively cheap compared to what is happening in other forms of retail. And a bit of a mantra that we threw out yesterday is big box, low cost. Just on our development pipeline, because we've been active once again, we're spending about $35 million a year. We have been delivering returns of in excess of 8% cash year one for most of our developments. We've completed 4 during the half. And in the last 3 years, we have built 16,000 square metres of additional GLA, which is the equivalent of basically building a centre for free with no land cost. So there's a lot of organic growth in this vehicle without us having to go actually chase acquisitions. Great case study. Probably about 40 investors and analysts joined us in November last year, and we took them up to Tuggerah on the Central Coast. It's a really good success story. Really proud of our team and what we've done here. So you can see this highlights acquisitions, development, leasing, asset management and marketing. So we picked up this asset for $41 million 3 years ago. We bought it off market. We've more than doubled the value in the last 3 years. We've added about $3 million in incremental rent. We've boosted traffic by about 50% since we've owned it, and we've taken occupancy from about 60% up to about 100%. And just to give you an idea for those visual in the room, which is probably most of us, the left-hand side is what we bought, which is pretty sad and unenergised and uninspiring. And on the right-hand side, it's vibrant, it's full, the tenants are happy, the local community has had a big impact. So I just wanted to share some of those results. And again, large format retail is very different from shopping centres, and that's my main message to leave with you, because there's going to be more noise around fashion and more noise around shopping centres. And at this stage, that's not having an impact on Aventus. Yes, our retailers' sales growth is moderating. However, they're coming off cyclical highs, and we encourage analysts and investors to look at the profitability and the balance sheet of our retailers as opposed to looking at the like-for-like sales growth. Because if you've been growing, as most of our retailers have, at sort of 2 to 10% positive comps, that's got to normalise over time. So you see Scarley's come out with flat, JB's at 3, but some of these guys have been cycling off 10% increases. And our other tenants, Beacon, Adairs, Baby Bunting, they're all category killers in their own space. And they're all highly profitable businesses, we believe, that will withstand whatever moderation comes in the coming few years.